Now this problem deals with, whether or not the company should pay a cash dividend or whether they should repurchase stock. And in this next part of the problem, they're asking us to estimate what we think the new price of the stock in the market will be if they do the repurchase. And the price of the stock in the market now, this is the earnings per share of a company multiplied by the firm's PE ratio. And they told us in the book that the firm's PE ratio was 10. So if we take the new earnings per share that we estimate to be $2.10, multiply that by the PE ratio in the market now, we would estimate that the new price of the stock in the market would be $21 a share. So the shareholders would see the price of their stock go up because of the repurchase. The next part says what happens with earnings per share. Well, we've kind of calculated that in other parts of this problem. We see that earnings per share will go up from $2 a share to $2.10 per share. That's important that earnings per share go up because, again, the normative objective function of the financial manager is to maximize the wealth of the shareholder, the value of the firm, the price of the stock in the market. So assuming that the PE ratio stays the same, if we maximize earnings per share, then we'll also maximize the price of the stock in the market. The last part of this problem now wants us to talk about the advantages between a cash dividend versus a stock repurchase. Now, if the company pays a cash dividend, the cash dividend now becomes taxable income, and that's going to be treated as ordinary income, and you're going to pay taxes on that just like you would if your employer gave you a raise. And so that's going to be taxable income, and that's probably going to be the highest tax rate that you pay. On the other hand, if they repurchase the stock, now if they repurchase the stock, the price of the stock we think will go up. Now that's not a problem though. That doesn't create a taxable event. A capital gain, the price is going up now, that defers taxes, that is, it puts it off into the future. So the stock repurchase creates a tax deferral, and we don't have to pay taxes on any of that increased value until we decide it's to our advantage to sell the stock. So if we don't sell the stock, then there's no tax consequence. The other thing about the deferral deal is that if we defer, put off until the future, selling the stock, then any gain that we get is going to be taxed as a capital gain. And the tax rate on capital gains are going to be lower than the tax rate you see on cash dividends. So one of the differences that they're talking about here between cash dividends and stock repurchases is what all investors face. Do I want cash dividends that I have to declare as ordinary income, or do I want to defer them, put it off into the future, and sell the stock at some point in the future if I need income, and then pay a lower capital gain? That's the tax difference between these two issues.